I want to talk to you about headline risk. I don't think anybody saw this coming. Obviously, the story broke over the weekend. How do you view the impact of this on the markets? We're already seeing a reaction in the bond markets.
Yeah, it's not surprising that we're seeing a knee-jerk reaction to this. I mean, markets have been somewhat complacent in terms of this headline risk, and the headline risk has been building aside from this the new news on Powell. So it's not surprising to see yields spiking on this, on longer maturity yields, and of course a more pronounced reaction because, look, we've seen sub-15 VIX for quite some time now, and that's usually an indicator of some complacency.
All right. You're thinking about complacency. I want to come over to you, Henrietta. You're also looking at the legislative process when it comes to all this and the potential impact on Lisa Cook as well. How are you viewing all this from an investor standpoint when it comes to headline risk and also this legislative process that you're concerned about? Could it impact investors as well?
Yeah, absolutely. The thing that's most shocking is we have one critical senator, Senator Tom Tillis of North Carolina, who's come out overnight and said he will not approve of any Powell replacement so long as this pressure campaign of fiscal dominance is happening from the White House. And that is going to logjam every other legislative item that President Trump wants. If you think there's a $2,000 tariff rebate check coming, think again. You do not have votes from the Republican conference for a partisan reconciliation bill, and you could be looking at another government shutdown since you need at least 8 and now maybe 10 Republican votes just to keep the lights on. So the legislative ramifications of this are widespread as well.
All right. Mark, I want to come back over to you. Does this change your view of what sectors you can invest in? I mean, we've seen a big cyclical rally, in all honesty, in recent days because a lot of people were expecting Fed rate cuts to come sometime next year. Does this change the math significantly on what sectors seem more attractive, what sectors seem less attractive?
I think in the near term, I think we're going to see volatility across all sectors as a result of a lot of this smoke that is now billowing through D.C. I think, but longer term, I think we have the same theses that we've been working on. Obviously, the sectors that are growing are going to continue to grow. Although you do see risk if you see longer term interest rates staying high, that could impact our growth sectors. However, now we're looking at defense sector as a result of these recent actions in Venezuela. You're
also looking at the VIX. Speaking of Venezuela, we also have some issues in Iran. We're going to get to that in just a moment. But you're looking at the VIX. You say it's still subdued. It's sitting at about 16.5 right now. If the VIX rises, what does that to you say about investor sentiment going forward and where you want to put money? Do you want to immediately go to defensive sectors? Because we also have the potential for tariffs to be struck down, which would also create more volatility.
Absolutely. I think, again, middle term and long term, I think we continue on the secular path. In the near term, I think you want to be a little bit selective because markets are going to go, back and forth. And I think, remember, volatility works in both directions. Assuming this stuff gets resolved and it's a lot of noise, it may take a little bit of time, but this may provide us with some buying opportunities.
All right, Henrietta, come back over to you again. We're going to have our Dan Murphy come up in a short bit to talk about Iran. But let's talk about domestic issues right now. You're saying there's a $3 trillion binary event. You're talking about the SCOTUS decision related to tariffs. We're expecting a decision from the Supreme Court coming up this week. We don't know if tariffs will be included, but you say $3 trillion binary event. Why is it binary?
Right. So the Supreme Court, if they strike down these IEEPA tariffs, that's it. I mean, they're either on or they're off. And one of the things that seemed so obvious last night is that the president is plainly worried about inflation. As we've seen corporations squeeze all they can out of the margin pressure that they've been able to avoid paying or passing the tariffs on to consumers about. Now we have a situation going into the first quarter of this year where they don't have that option anymore. We've got to see prices increase. So when the Supreme Court, if they strike down the tariffs, which we believe is a 65% odds event, the market's a little higher at 75, 80% odds that they'll strike it down. The president has a choice. There's no legislative agenda to work through here. You don't have the votes for a partisan reconciliation bill. There's no bipartisan consensus to boost the economy. The best thing Trump could do is let the Supreme Court take the tariffs off and then leave them that way. The alternative is Liberation Day 2.0. We don't want that. That's too much uncertainty. Disruption is rampant, and the inflation risk will migrate around to different sectors and different nations in a vast array of confusion. So we have this opportunity here for the president himself to take these tariffs off and juice the economy going into the midterms. If you want inflation down, this is the fastest way to make it happen. Take the tariffs off.
Yeah, I think a lot of companies are hoping that they get either tariff refunds or the tariffs go down. We're actually going to hit on how companies are planning for those tariffs coming up a bit later in the show. But right now, we want to turn our attention to a developing story in the Middle East. President Trump reportedly weighing options, including military strikes on Iran, as civil unrest in that country continues this morning. The president is scheduled to meet with senior officials as soon as tomorrow, but he says he's now considering, quote, strong options.
There seem to be some people killed that aren't supposed to be killed. These are violent, if you call them leaders, I don't know if they're leaders or just they rule through violence. But we're looking at it very seriously. The military is looking at it, and we're looking at some very strong options. We'll make a determination.
CNBC's Dan Murphy's following the very latest on this story. He joins us now from Dubai on the CNBC Newsline. Dan, good morning.
Frank, good morning to you. Well, as you've just heard, the rhetoric here certainly ramping up. President Donald Trump says he's now actively weighing what he calls very strong options, including military action as these protests continue to shake Iran. And of course, Frank, this matters for investors, and traders are watching this closely. Any U.S. military move would raise concerns around things like regional stability, things like sanctions enforcement, even the geopolitical risk premium for crude. Interestingly, so far, we're not seeing this being reflected in oil market pricing right now, but the escalation risk is real. President Trump also saying the U.S. may meet Iranian officials and is also in contact with opposition figures. The president certainly making it clear that Iran will face consequences if security forces continue to use force against these protesters. And of course, as you would expect, Iranian officials have also shot back today. They say any U.S. intervention would make American and Israeli assets in the region legitimate targets as well. Iran's foreign minister, Abbas Araghchi, also saying Iran is, quote, ready for war, but also for dialogue. Frank, at the same time, U.S.-based rights groups say hundreds of protesters have been killed, thousands have been arrested, but those figures can't be independently verified because of a near total internet blackout currently happening on the ground, put in place to quell those protests. So for markets, the risk now is whether this escalates into new sanctions or military action that could disrupt oil flows or undermine regional stability. Frank, as I mentioned, on the oil front, we're not necessarily seeing this being reflected right now, but of course, traders watching this really closely.
All right. Dan Murphy, live in Dubai on the CNBC Newsline. Dan, thank you very much. Henriette, I want to come right back over to you as we look at what this Iran situation could mean, not only for the oil market, for the broader geopolitical markets right now. Now, I'm looking at oil, and Dan hit on this. Oil's actually down a bit surprising considering the fact that Iran's an oil-producing country. But outside of oil, what are the risks for investors here? What concerns should investors have about this situation?
The biggest concern has got to obviously be focused on oil, but more than that is the president's $1.5 trillion investment in defense. Our view has long been that defense spending will continue to rise. We've thought that federal spending will continue to rise. Both of those are true. But the money that the White House is now looking for the Defense Department is 50% larger than it was last year. And what happens in D.C. is that when you increase defense, you also have to increase non-defense. So weirdly, if you want to connect the dots here, this is important for bond markets because the president is not just increasing defense spending by $500 billion or $600 billion, but to get that bill through, that means you have to increase domestic non-defense discretionary by that same amount. So the deficit increases we will be incurring as a result of that increase, and the continued focus on defense, the continued sort of adventurism abroad is something that's going to have rebound effects, not just on defense, but also on domestic discretionary. And that's for the bond markets, a critical thing to watch going into 2026 and a government shutdown on January 30th.
Yeah, we're certainly watching that bond market this morning. Mark, I'm going to give you the last word. You were nodding as Henry was talking, specifically about bond yields rising. Are you concerned about the rise of bond yields? Does it change again? Some area of the market that you see is investable right now, or where you would actually have your clients put money to work?
Oh, absolutely. I agree 100% with Henrietta on that. Look, those bond yields are so important right now mainly because of the in my opinion, the growth sectors that everyone loves to invest in, right? They've become so sensitive to bond yields, and we see so many things right now. The headline risk really is it's screaming bond yields rising, right? The tariff issue, the defense spending. Clearly, this thing is screaming defense investment. However, there's going to be bigger challenges as a result of the deficit.
Can I ask you one quick question?
Sure.
We do have to go. Haven't we seen the tech sector, the Mag 7 and other big tech names be defensive trades in recent months, especially over the last year?
Absolutely. But when interest rates are spiking, you're going to have big challenges. You're going to have headwinds with that stuff.